Welcome again. Today is NSE share trading recorded version. We'll be doing a live session now for what we have covered so far in the coming training on Wednesday. So today I want us to understand one recurring item in financial results that may project profits or revenues high or cash flow, but may not be there in the next financial year, and its effect both on dividend on your capital gains. So why recorded profits don't always mean sustainable growth. And if you have any question, if you are stuck anywhere, you can always reach out to my WhatsApp number. This is for communication. It's my personal number, so you can always reach out anytime. I'm always open to assist in matters of investment, stock market, boards, international markets, ETFs, pension, money market fund, and others. So let's run together. So let's understand what one-off or non-recurring items are. A one-off item, that is a non-recurring item, as the word says, non-recurring, it's item that temporary gains or losses that inflate or reduce earnings but don't reflect regular operations. Just think of it. A company reports a profit when they have just sold a house, or they have been paid, like what happened with Umeme, they have been paid maybe a compensation. That's a one-off. It won't recur next year, and next year but one. It's not a profit coming from gains that will drive the company in future. Even in losses, maybe it is a penalty they were paying. That penalty will not recur next year. That's why it is a one-off item in the financial statements, financial results that may push or inflate or reduce the earnings. This makes EPS, that is earning per share, and dividend growth look stronger or weaker than the real trade. Remember, when you're buying shares, most of analysts, they tell you EPS and dividend growth as the basis of buying shares. But for them, they base it on reported profits, recorded profit by the company. But is it the real profit with that company? Is it the real loss with that company? So in the market, it will make the stock look promising, or on downside maybe make the stock look like it's not profitable, while in real sense it is the opposite. These are things you need to interrogate, and that's why I always advise, when you receive financial results, always read notes. If you have a chance to get full audited results, the full booklet, the detailed one, the better. These days, like KPLC, I've seen for the last 2 years, they have not given detailed. When they were making losses, they used to give. Why did they stop? You find most of the items there that are being reported in the condensed financial results don't project the real performance of the company. They are usually done for the market, and all those reports are just for the market because they are required by the regulator to report. And that is the downside of our market. It is the regulator who have required them to make those announcements. If they are given time and give the right announcement, you may find some of the recommendations we get there, they're just there for the market. So of that, let's look at the items that you may need to look at. One is asset sale and disposable gains. You go to the other income and the income statement. This just boosts profit temporarily, but they are not repeatable. Next year you will not find them. If you look at Equity Bank full year results for 2024, you find in the cash flow statement there is a sale of assets and buyback. You just look at it, the detailed one. You try to ask yourself, did they sell an asset and buy another one? Sell at a higher price, then buy another one at a lower price. Most of these are evaluations, and unfortunately the auditors, I don't know whether maybe they are allowed to do that. some of these things are not things you post on financial results, because for a person who is keen on details, we start questioning that financial results. Tax benefits and deferred reversals. Always go to notes or tax section. It details everything. It lowers tax expenses, which then inflates net profit. But it's not the cash that this company need. It's just tax adjustment, just for the books. Then there is a FX gain or hyperinflation adjustments. You just go to other income or financial income. It will increase the reported profit, but not cash profit. Look at KPLC. They have FX gain adjustments. I think even Safaricom have seen that, even equity. But those affect their profit after tax. You find it is high. But then, in terms of cash flow, is the real cash there? Restructuring and write-backs, you got footnotes or exceptional items. It is a one-item accounting gain, but not operational. Then there is a account standard stage. If you go to equity full year results, detailed one, they have that section. And it is there, changes in financial accounting standard. Just go to the notes of financials, you'll see that. These are non-cash impact. They only affect comparability. That is comparison of now equity with other peers in the same sector. Then there are government subsidies and grants. You just go to other income. These are not business-driven profits. They just mask weak cash flow. And any company with government subsidies, you need to be worried about. Look at Mumias. It used to have government subsidies or one now and then, even KQ. But then, after some time, what happened? They start reporting their cash. That is losses. Then at that point, that's when, as an investor, you realize you got into a loss-making company that doesn't stand by fundamentals, and prices come down. You're left with a stock that you can only sell at a loss. Why then this matters? One, it inflates EPS, and this EPS, earning per share, is what people use to value stocks in the market. As I've said, don't use one single formula to value a stock. Actually, forget about technical analysis. That is just for numbers. And the numbers we're using are these ones we are trying to interrogate here, whether they are real or not. If you need to do a detailed analysis of that financial results, derive your own EPS based on what is not supposed to be in that financial results. So that you are not misread to think that there is growth in that company, while in essence there is none. Company are just revaluing their assets, rebalancing their books. But that does not mean that is the real growth out there. Dividends which are financed by a one-off profit, they are not sustainable. Look at Umeme. They were paid money by Uganda government and paid it as a dividend. But this year, will they give another dividend? It was just a one-off. So when you see a company giving a dividend out of sale of an asset, or they are paid for, maybe they won a court case, they awarded damages, and they are giving it as a dividend. Don't be happy about that dividend. It's a one-off. It won't recur next time. And that's why you find companies like Safaricom, they give those one-off profits as special dividend because they know it won't recur again. And these are companies you want to get into, where dividend is supported by their cash flow, not inflated profits. So So the true value lies in free cash flow, FCF. I shown you in the last video how to calculate it. And there are investors who are worried, where did I get my figures? I actually removed some of these items that are not supposed to be in cash flow statement. They are not like Equity Bank, a sale and a buyback. I hope it's not a revaluation of an asset they are trying to do, because then it will mislead you to think they have that money. And also core operating income, not the report, not income that is reported on headlines. Always interrogate those results. If you can, always have a spreadsheet template where you can feed in the real data and try to compare with what is reported. So some of the metrics to look at is the FCF payout ratio that we did in the previous video for dividend trap. So it is total dividend paid divided by free cash flow. It tests whether dividend is suitable. Does it even stand test of time? Or it would be just a one-off dividend, then you are left with a stock that now you either make capital gains or eventually you get capital loss. Then core EPS, not the reported, not the one that is shown on those financial results. Most of them, they even give you that EPS. And most of us will rely with that. Remember, it includes some of those adjustments. So how you get the real EPS is you get the net profit from the financial statement minus one-off items. You need to list them down, those one-off items. Then you divide by total number of shares. That gives you the real profitability of the company. When you see an analyst telling you EPS is this, just ask them, did you remove one-off items? Because that's very important. It will show you growth this year. Then next year they tell you growth have gone down. They forgot the previous year to remove that one-off item so that they have real EPS. Then in recurring revenue growth, you take the core revenue that is reported, then minus prior year core revenue, then divide by prior year core revenue. That way it filters out temporary boosts. So that gives you the real revenue growth. Current year growth minus previous year divided by prior year. So that you filter out those temporary boosts that are put in the financials just to report for profits. So as a takeaway, before you celebrate record EPS and you go to the market and start buying, check if that profit came from core operations or one-off item. If it is one-off item, then you're not getting into a company that starts test of time. Then compare cash flow versus net profit. Then adjust for temporary gains before projecting dividend and valuations. And I hope analysts would start factoring out these temporary gains, because they may project growth where in this sense that company is not growing. Then eventually when the company collapses, you start wondering, why did these people project growth? And remember, in those analyst reports, there is always a disclaimer. You can't hold them accountable. That is the broker. So let's just quickly go through some of the reports that we did in the previous video. Equity Group Holding for the financial year 2024. They have recorded a good profit, but how much is core? That is, how much is the real profit? They are saying profit after tax 48.8 billion. Other income also rose. But then, what is driving this growth and also this profit? It's only a huge rise in income interest income from placement with banks. That is the deposits they have done with other banks, the interest they have. That you can always get in their full financial. If you go through it, you get some of these items. It's only that I just picked this one, but there are many other. The valuation of assets, which it's not clear, but you can see it's just valuing an asset. Why does this matter? Because interest income from placement from the banks is not, it's an non-core income. Equity's main business is trading. That's where they make money from. Not parking that excess cash in another bank to earn interest. It means then they are not generating more income from their main business. And you need to compare these non-core with the core. If non-core is more, then that's a business that is struggling. It's trying to look for other avenues to make money to stay afloat. So I don't want to do those comparisons now. I'll do in the next video when we are doing live training. So future profits may drop when rates fall or placement shrink. Remember, interest rates, they are pegged on the rates from CBK. If they fall, then it means equity is not earning more money from those placement with banks. Then there is EABL, FX gain. I think that's what they have highlighted on their financial results. They mask underlying pressure. This company may be under pressure, but using FX gains to project growth. So if you got management commentary, profits partly supported by foreign exchange gains and lower finance cost after debt restructuring. What does that mean? If they owe maybe a company some money, instead of paying that debt, they go and restructure, maybe they renegotiate for another repayment. So that will not be projected on the financial results. It will only inflate their earnings, their revenue. So why does this matter? These are non-recurring. It won't be done next year. Or maybe next year, foreign exchange may have gone down. Then, so without FX gains, operational margins may be weaker due to high input and exercise costs. These are companies that is producing beer. They may have high input and exercise cost. So dividend, you may find it stays afloat or decline unless now KPLC recover. So these are some of the things you need to interrogate on the financial results, so that you don't buy a stock thinking it is a strong company, where in real sense it's just accounting readjustments that make it look profitable in paper. So Safaricom, again from the previous video, strong cash flow, but always watch adjustment. So if you look at their financial results, they have including hyperinflation and FX adjustments from Ethiopia. These are markets that is still stabilizing. Why these matter? Because profit includes these accounting adjustments that may not repeat maybe in near future. What if they decide to sell that unit or to close it down? So you need to always check whatever is reported in the financial results. So for Safaricom, it's still a cash-backed dividend, but there are risks in that expansion. You need to watch closely how it will affect its cash flow and also reported revenues. Then we have Kenya Power. You may find for Kenya Power, their results includes previous year's FX gains and also tariff refills, but which may eventually be reversed in 2025. I hope if they were to release full results, we could see this picture. But you can always tell if you have to compare last year in 2023 and 2024. Then you go to the previous year, full audited results. You see some of these items, they are factored in there. So why this matters? It's a one-off, and when this one-off fade, profit and cash narrow. Eventually, dividend becomes unsustainable. So you may find even dividend from Kenya Power depends on the tariff stability and cost recovery. But is it a recurring thing? Is it guaranteed? These are things then which you come to realize later when now they decide to raise the results, and you see over the years these were some of the things that were put there just to project profits. So always read beyond profit after tax. It's not the final thing. Don't go straight to profit after tax. Interrogate that statement, that financial statement for P&L. Check notes for non-recurring income. Exclude them. You'll have the real income that business is generating. Then calculate adjusted profit. That is profit after tax minus all the one-off items. Now adjusted profit is the actual profit. Now you should be dealing with. Because now if you have to compare this adjusted profit with the real free cash flow, then it can tell whether there is consistency. And where there is consistency, remember there is safety. It is all about your money. Your money is safe and you make gains. So avoid buying shares on recorded profits until you confirm suitability. You need to check that profit after tax. After you remove one-off items, do they still stand on profit? If they are not, then know this is a company that's always making losses, but profits are projected from the market. So dividends funded by recurring cash flow are the only safe ones, and they are the ones now that help you build your wealth in future, and also capital growth. Well, that's a company that now is supported by real cash flow, as we said in dividend travel video. And with that, I'd like to thank you so much. Remember to like and share if you found this video helpful, and subscribe for more if you have not done that. We are breaking NSE into details so that you know whether you are getting into real cash cow. We call NSE cash cow because that's where you can make real gains quickly. It has the highest growth in terms of returns, but again highest capital loss if you don't watch closely, because prices can go either way. If you panic, you may lose if you sell at a loss. You can check the detailed tutorial on my blog. I will leave that link in the description of this video, and also these notes will be available for download. I will share that link on our WhatsApp community. My Wealth Guide KE link will be in the description of this video, and also Telegram channel. I'm also starting TikTok, Facebook, Instagram, LinkedIn, X, and other social media accounts, and you are free to support us. Thank you so much. Let's meet in the next one.